Hi guys, welcome to 365 days, 365 concepts. The concept that we're going to understand today is behavioral finance. But before this, let us discuss a story. So I have this friend, when she was a child, she fell down when she was riding a bicycle. Now what happens because of this? There's a fear that has been instilled in her head that bicycles are not safe. That emotion is running in her mind all the time. Now, whenever she sees a bicycle, she prefers not to use that as a mode of transport because that emotion is playing in her head, that fear isn't playing in her head that it's not safe. She's not being rational, she's not being emotionless. When she's making that decision that whether I should ride a bicycle or not, in fact, that fear is coming in her head that, oh, this is not safe because of an incident that happened in her childhood. Exactly like that, behavioral finance is the study of how the investor who is participating in the capital markets makes a decision as opposed to being a rational investor who is emotionless. I hope you all or we all are, people and individuals who are driven by emotions. Of course, whenever we participate in capital markets, example stock market, we will obviously our decisions will be driven by our emotions, right? None of us can, overpower our emotions completely. So investors generally tend to exhibit certain biases in their decision making, certain preconceived notions in their decision making whenever they participate in the capital markets. And study of this biases is called as behavioral finance. And you know what? If I want to buy a certain stock, of course, I should study that how the balance sheet is, how the profit and loss is, or how the company's management is, how the business model is. All of that I should study, but also I should study the investor's psychology. It is very important, the investors who are participating in the market. Understanding psychology is a very, very important aspect of investing in the markets. And that is what behavioral finance teaches you. Sir, what are the types of biases that are exhibited by individuals who participate in the market? There are a few types that we are going to discuss today. First is loss aversion bias. Sir, what do you mean by this? Let me just quickly explain to you guys. It's very simple. Let's say there's a 10,000 rupee gain that you have and an equal amount of loss, that is 10,000 rupees loss that you have. You know what? The happiness that the gain is going to give you, the pain that you will suffer from the loss that you have is going to be much, much more. We all are like that, right? Probably this will give you, 100 happiness. You cannot measure happiness, but let's just say we can. This is giving you 100 happiness. This will give you much more pain because we all are built like that. We all have an aversion towards loss. We all avoid losses. And that's the first bias that every individual exhibits. I mean, a lot of us. Some of us are, of course, they like, they're different, but a lot of us exhibit this. Next is investor overconfidence, where an individual gets what? An individual gets a huge amount of overconfidence in their abilities. Let's take an example. I'm sure all of you guys would have heard about this company called Eicher Motors. Let's say I'm studying Eicher Motors and I invest in the company because of their truck business. Because I feel that the business is very good and the company is going to do very well. They manufacture trucks, right? But tomorrow, you know what happened? The company started to do very well because of their bike business, which is Royal Enfield. The company started to earn a lot of money and the stock price rose. Now, you tell me, as an investor, of course, I'm going to get a gain because I've invested in Eicher Motors, but is it because of my analysis or it's purely luck? Sir, it is purely luck. It is not because of my analysis, because my analysis what was, that the truck business is going to do very well. What happens because of this? I get overconfidence in my ability to predict the returns, my ability to invest, right? And tomorrow I'll feel that, okay, whatever decision I take is going to be right because, look, Eicher Motors did very well. Now, whenever I make an investment in the market tomorrow, I'm going to make it, I'm going to earn a lot of money. And that gives you a false sense of overconfidence. And that is what investor overconfidence is, right? So these are the two types of biases. First is loss aversion. Other one is investor overconfidence. And the last bias that we're going to discuss is hoarding effect. Now, what exactly hoarding effect is? Herding effect is rather than doing your own individual analysis, rather than understanding that whether this investment is very good for you or not, you do what the rest of the market is doing. Array, everyone is buying crypto. Let us buy crypto. You know what happened because after that, the crypto market fell down, and of course, a lot of people suffered losses. A classic example of herding, because everyone was doing it out of FOMO, fear of missing out. I started doing it, and that effect is called as herding. I did not care for whether it is appropriate for me, whether this investment is good or not. I did not do any of the analysis. I simply bought what everyone else was buying, and that is what herding as a bias is. I hope you guys understood what behavioral finance is. Please like, share, comment, and subscribe. Please, if there are any doubts, feel free to comment down below, and I'll be happy to answer it. Thank you so much. Bye bye.